Hi, everyone. On behalf of AKC Capital, we wanted to present a perspective on the equity markets and the view going forward. It gives me immense pleasure today to have Mr. Manish R, Head Product Communication from ICICI Prudential Asset Management Company, and over to him to share his perspectives.
Thank you for welcoming us, and it's always a pleasure to chat
Thank you,
on
Manish.
markets. Thank you.
So I know that equity markets, as you know, have been very challenging.
Correct.
We're getting a lot of queries. What is the view going forward, especially in the aftermath of the globally high inflation and other factors? So my first question to you, Manish, would be, what really is the investment philosophy of ICICI Prudential AMC, especially in these turbulent times?
Sure. So I'll start with an analogy, and this is something which we normally observe whenever we enter an aircraft. You would be seeing that the pilot has a very long checklist. That is the aircraft temperature okay, is the brakes working, is the lights working, etc. So it's kind of a checklist. At least it will give you a clear roadmap that everything is in place, right? So similarly, we also follow a checklist, or you can say that our investment philosophy whenever we see that market is extremely turbulent and all. So I would like to highlight that philosophy here, that we follow a framework called as VCTS. And if I expand the acronym here, V stands for valuations. And if you look at India's valuations today, so if I give you some example like price to earnings, which is somewhere close to 22 and a half. If you look at market cap to GDP, that's somewhere around 108, 109%. So if you look at from the valuations perspective, the first element of VCTS, India is not cheap at this point of time. That's clearly coming out from valuations. But if you move on to the second element, that is C, or if you expand, we call it as business cycle. But if you look at from the business cycle perspective, India is looking extremely positive at this point of time. So if I talk about certain indicators in business cycle, so for example, credit growth, we were languishing at close to 4.5% during the pandemic period. Now it has started to pick up to almost close to 15 and a half, 16%. So that's something clearly highlights that the credit cycle is starting to pick up. Business cycle is becoming positive. You look at capacity utilization as an indicator, which talks about how much capacity the corporates are working at. So we have seen it at 45% during the pandemic. Now it has picked up to almost close to 75-76% kind of thing. Whether you're looking at corporate profit to GDP, that has started to pick up, touching almost close to 4.1%, and we have seen it around 1.5%. So the second element which is there, the business cycle is looking positive. That's why there is good vibrance to the Indian market and all. So that's C. If we move to the third indicator, let's say trigger. And that's something which, if I have to elaborate, triggers is something which can move the market either in a positive manner or in a negative manner. And that's something which we need to look at on what's going to happen in the next 3-6 months. So if you look at from the trigger points, there are a lot of triggers which are there at this point of time at play. First is obviously US Fed. The kind of trajectory which they're going to follow in terms of rate hike, in terms of taking out liquidity from the system. And we've just finished the this September month policy, and it's clear that they're going to go for a very aggressive rate hike, and in the coming months they're going to be more aggressive on the rate hike side. So if that happens, that can have some negative repercussions on the emerging market, although India has kind of remained immune, and you have seen it. It's not behaved like what is expected, but that's a trigger which you should keep it in mind. Second thing is obviously the geopolitical tension which is happening. That's one of the trigger which we look at
Absolutely.
very closely, and that can have impact on various commodity prices, oil, etc. and all.
Correct.
So if the geopolitical tension completely moves out, that's positive for the equity market. Your commodity prices and all can come down. But if it continues, then those, especially the commodity prices remaining sticky or high, can lead to inflation moving higher, and that in turn will have a signal for US Fed or other global central banks to remain aggressive, and they can keep on tightening the screw, and which can take the growth slightly. And the final thing in the VCTS framework, the S part is sentiments. So I've covered valuation cycle, trigger. Sentiments part is something which has to do more with how the investor behavior is. That's also an important aspect, which we
one of the most relevant aspects.
Absolutely. So for India, actually, even in the last 1.5 years, where we have seen FIIs been selling so aggressively, but the DII being so positive, or they've been pumping the money on a month-on-month basis, that has kept the Indian market much resilient as compared to other emerging markets. So sentiments is something which we need to look at very closely. At this point of time, I think after almost 9-10 months of massive FIS selling, FIF have started to come back. And DI has remained positive, especially if you look at the SIP book, which is clocking almost 11,000, 12,000 crores. That something is supporting the Indian market, and with FII coming back. So clearly, in terms of sentiments wise also, we are not at a very low level, I can say, because sentiments is quite high at this point of time. So if I have to summarize and give a view for overall the equity market, valuations remaining high. So that's kind of a cautious indicator at this point of time. Cycle being extremely positive, that makes us positive that from a long-term perspective, you should look at equity, Indian equity market if you have a long-term view. Triggers is something which is which you have to see how it's going to plan out in the coming 6 months or a 1-year period. So triggers is, there are triggers which are at play. So you cannot take a very fixed view and remain fixated to that. You need to be extremely nimble. You need to be extremely flexible. You should be comfortable moving between equity, debt and all. So trigger clearly highlights that you should have flexibility in your portfolio. You should have equity, debt and all. And fourth and final, sentiments is something which is not very low. Sentiments remains high. So everybody is a buyer in the Indian equity market. In fact, FI feels that India has the cleanest shirt. So sentiments is high. That also is kind of, we should be cautious on. So overall equity market, I think this is the time when you should be flexible, nimble, have better asset allocation in your portfolio.
I think thank you for bringing forth this framework, and I think VCTS framework is really the core philosophy which ICCI is following today, and I think it kind of makes the whole investment approach much more systematic, process oriented.
Absolutely.
And just to extend, like what you said, while from a long-term perspective, obviously India has a growth story. There's a lot of potential over this decade, but there are certain factors, as viewers would like to know, is that sentiments sometimes can change. We highlighted something about the Fed action, globally high inflation, etc. So I think one needs to kind of strike an optimum balance. What I'm taking from this conversation, while investors should come with a long-term view, but at the same time should come with this, be cautious of these other factors.
Triggers.
And somewhere I think what you were also trying to bring forth is that equity, staggered allocations, because you may not want to time the markets, but probably staggering allocations, given the high valuations and hence some volatility around that, profit booking could be on the cards, could probably be the way forward.
Absolutely,
but
I think.
Nevertheless, well noted the framework, I think, which brings me to my second question.
Sure.
What is your view on the possibility of recession in US and Europe? And how do you see that impacting the Indian market in the medium and the long run? So any inputs that side?
Sure. Keep my answer short over here, because it's something which you have to have we say that a crystal gaze, and then you're able to look into that future and also but what I can gather from the data points which are available at this point of time, and that's what been highlighted very clearly by US Fed also, that things are pretty positive in terms of the US economy, in terms of the unemployment rate. If you're talking about the retail sales which is there, even after they hiking the rates, things are still decent in US, and that's what they were a little worried that I think they clearly said that we have to be slightly more aggressive because inflation is not coming down, but the demand or the growth is still positive. So if you look at other economies also, like China also has given a positive surprise that the numbers which are coming out of China were also positive. Similarly, like I highlighted, in US also it's looking positive. So clearly Fed is going to be aggressive in terms of their approach. That's what is coming out from their commentary, and maybe the terminal value for their Fed rates can be around 440 or 450. That's what is the expectation in the coming few months. The terminal rate can touch 440, 450. So with that rate, definitely you can see some growth slowdown. But the bigger question is whether this will lead to a recession. Is something which is the jury is still out. But what we feel is that clearly US, there would be some slowdown because you're tightening the tap by having a rate hikes, liquidity going out of the equation and all that. And this has led to quite a good correction in the US market also, and the growth also kind of slowing down. So you will see a growth coming down in US, but a recession is something which is a question mark. But when you talk about Europe, mainly because of the war and all, unfortunately the scenario for US market is slightly more grim, I can say. There the growth slowdown or the landing can be slightly more harder, as compared to US. So US is still better off compared to Europe, but Europe, we expect you can see some hard landing kind of a thing. And if you relate it with Indian markets, and normally India has a good export exposure towards US and Europe. So so the sectors or the themes which have that kind of an exposure will have a kind of a slowdown. But overall, if you talk about India as an economy and the macro indicators which I have put across, especially when you're talking about credit growth, capacity utilization, slowly the rural growth starting to pick up, urban growth is looking decent, corporate balance sheet is decent, household balance sheet is not leveraged. So what we feel is that Indian economy or the sectors or themes which are inward facing, which is more focused on India growth story or India economy doing well, I think they are going to take the baton forward, and I think that should continue the Indian equity markets to do much better, even from a perspective of, let's say, medium to long.
I think viewers have very interesting perspective here. I think clearly, as Manish has pointed out, I think it's too early in the day, as you could say, to say whether US would actually get into a recession. But I think what I could probably make out of the word is that the probability is always there around the corner. The other point which is clearly coming out of this conversation is that Europe tends to be on a little more sticky wicket. While at the same time, I think, and as you rightly pointed out, I think sectors which are more inward looking to Indian equity markets would kind of tend to do well. Obviously, we are no longer kind of decoupled from US markets. So obviously, if something happens there, you always feel the pain this side as well. But I think what is really coming clearly is that Fed would continue to be on a kind of a rate hike. Obviously, the central goal there being to bring down inflation to a long-term average of 2%. You did touch on the terminal value of the inflation, and it's around 4.5 is what it is. So I think to summarize, my sense is that yes, there's a little bit of challenging rate hikes, and it would have an impact on the economy. Obviously, it would have some slowdown in US economy as well, but we really need to watch that out. And end of the day, I think, as you know, that the focus for Indian economy continues to be strong. So I think the key takeaway for viewers is and investors is that have portfolios which probably would be more geared towards Indian market, inward looking, and sectors inside. I think, and
Exactly.
that's if I hope I've summarized your
That
points well.
that's exactly.
Which brings us to the third point in my question to you. Is the move to include the Indian bonds in the JP Morgan Emerging Markets Index a positive move? And how do you see this impacting the debt markets, including challenges, if any?
Sure. I think the bigger question over here is that is when.
Yeah.
And we all know that very high probability that there would be an inclusion which is going to happen. So the question is that will Indian bonds is going to get included in the global index?
Yeah.
The answer is yes, but when it is going to happen, whether it's going to happen in the September review or is it going to happen in the 2023 is the bigger question.
Right.
But clearly, if you look at from a FII perspective, a 1.1 trillion USD debt market, investment grade, much stable economy, macros are looking decent.
Right.
So why not? So answer is very clearly people are comfortable, FIS are pushing for this. The answer is when is that's the question, and expectation is maybe September or maybe next year.
Okay.
And clearly with some of the country indices going out, like for example, Russia just got exited from the global index, and that created more of a concentration for other countries' bonds, due to which this stock is actually gaining strength. That there is a very high possibility that India inclusion can happen. Now, if this happens, it might result into an inflow of close to USD 30 or 40 billion.
Yeah.
Right. And India's exposure can slowly get constructed to a level of 10% in the index also.
Okay.
That's a possibility.
Okay.
So a 30 to 40 billion inflow is what you're seeing. If this happens, clearly it's a positive for the Indian bond market. You will get much better liquidity on the G-Sec space. Although India has been very careful in terms of India has been very careful in FPI's limits. They've been very, very careful on that aspect. But with this, maybe we can see this kind of a flows. Having said that, whether it would be positive for us to kind of manage the huge borrowing program which RBI has to take care of it. Yes, it should be positive, but if this kind of a flow is going to come on a year-on-year kind of a basis, then it's very clear that RBI might go very slow on the OMO side.
Okay.
So what they used to absorb the GSEC supply, if there is too much of a GSEC supply, they might take a backseat.
Okay.
And they will allow this kind of an FIS to take it. So it's kind of a neutral when you talk about the supply demand kind of a thing. And RBI would be very happy that if they have to take that lesser pain of absorbing that supply, then they can do that very clearly.
Interesting.
So in short, the question is when, but yeah, clearly there should be an inclusion which can happen. Kind of neutral for the borrowing program in terms of matching up demand supply thing.
Yeah, no, I think interesting perspective, and I think thanks for sharing your views on that. And clearly, I think if I may add to that point, if you mentioned about $30 to $40 billion this financial year, I think to some extent it would support the domestic currency as well.
Correct.
So given the pressure that rupee has been under on account of FI outflows, which we've seen from last October till June of this year. But I think overall what I could take away from this conversation is that overall it should be a positive. RBI will have to manage its borrowing program in the OMO and other factors, but overall it should be. And I think one of the things which that we are looking at is that also how do you settle these trades? And I think if I were to add that RBI is working out the mechanism as to how you settle these trades and the mechanism around that. I think some clarity, my assumption is, would emerge in the coming quarter,
Sure.
which should help in getting
Exactly.
this thing going
In
forward.
fact, they have to be like, when you look at from FI perspective also, okay, it's fine that it's getting included, but even when FIs invest also, they also take into consideration, which you highlighted a very important point, that currency. So if they are expecting that if US dollar is going to appreciate, and maybe INR currency can depreciate, then they would be slightly slow in terms of doing a bigger allocation to this JP Morgan Global Emerging Market Index, which you're talking about. So clearly, this is a perspective which we are giving, that okay, things looks good, 30-40 billion and all can come, but there is a lot of other dynamics also which comes into picture. So FIs also need to be very clear that how is it the dollar index is gonna move, how is Indian currency gonna move, and based on that they can also allocate accordingly.
Sure. Thank you so much. And so as we move on, the other question, what are the key factors that you feel will support the India growth story in this decade, or let us say keep the economy resilient? And I must say this is a question which is so common, and and investors, I'm sure, would the viewers would like to know. So what's your view on that?
I think I'll try to divide it into buckets because this is a very broad question and you're asking for a decade, right? So I'll keep it in a very simple buckets. Right?
Okay.
So some buckets, like if I would like to put it like demand, you put it supply, and then you talk about the third bucket is ecosystem, right?
Wow,
so when we talk
that's
about
interesting.
So when you talk about demand, and demand is something where I would relate to how is the demand from the household, how is the demand from consumption side it's coming. So when you look at from the demand angle, I think like I highlighted, the household balance sheet is still not very leveraged like other economies.
Absolutely.
So if you look at household debt, it's still low, and if you compare it with GDP, it's still around 16 or 17 or 18% around in terms of household debt to GDP, right? So it's not a very levered economy. In terms of the demand environment, it's a population which is growing. The per capita income is currently, let's say, around 2,000, but very high expectation that in the coming years it should move that 3,000, 4,000 mark. And once you see that 3,000, 4,000 mark moving around, clearly the non-linear growth in terms of when you're talking about penetration in refrigerator or an AC or an auto car, etc., can all come into picture. What we have seen in China, what we have seen in other countries, right? So you have a population set. The users are massive. You have a huge population. Their usage, or in terms of penetration for many goods, are low. So a combination of user and usage clearly is something which we see that the demand from the Indian households is going to be extremely positive, and that is going to give a very good visibility for the most of the corporates. So the first element, demand, clearly in place at this point of time. When we move to the second bucket, that is on the supply, and we say that how is the corporates looking, how is the government spending and all looking at this point of time. So when you look at corporate balance sheet also at this point of time, the corporate balance sheet is again strong. And if again I give you a number, it's around about 46% debt to GDP. Corporate debt to GDP is around 46%.
46%.
And we have seen almost during the pandemic or pre-pandemic, we have seen it close to 61-62% corporate debt to GDP. So that has come down. That's a very positive sign. If you look at other health related to corporate, the upgrades to downgrade ratio, which normally CRISIL publishes, 3-4 years back it was 0.9. That means more downgrades as compared to upgrades.
Correct.
Now that ratio is touching almost 5.
Okay, sea change.
Sea change, exactly. So you're seeing corporates getting upgraded based on the balance sheet, health of the thing and all, demand, etc. So corporate balance sheet is improving massively. Capacity utilization, which I have highlighted in that VCTS framework, which is a very good indicator that for corporates to understand whether they wanted to go for more spending, capacity spending or private spending. Capacity utilization is touching 75-76%. Credit growth is picking. People are more open to take loans. So I'm saying the second bucket, that's corporate side, also is looking positive. And in terms of it's looking very positive for a very long kind of a time. And the third element, which I said, the ecosystem, which should ensure that all this is going to sustain for a very long period of time. So at this point of time, if you look at ecosystem wise, clearly government is creating a very solid, robust ecosystem for corporates, and I can go on and on the kind of reforms which they have taken. Starting from corporate tax cut, which happened in 2019, where corporate tax has been slashed to 25%. And if you are a new manufacturing setup, you can have a tax of you just have to pay a 15% tax. So the blended corporate tax comes around 23%, which puts exactly in comparison to most of the emerging peers. So that's one initiative. Other initiative, if I talk about the Bankruptcy Code, which has been created, resolution of thing, consolidation of PSU banks, PLI schemes, which is, we feel that that's something which can put India in a very in a kind of a center stage for an export hub. So PLI schemes in almost 14 different sectors which has been created. I think that's something which is a very good ecosystem which is getting created at this point of time. And if I talk about the ecosystem, the second part which is extremely important, so this was related to government. The second part, if I talk about on the ecosystem, is how the global environment is shaping up. So I think with China plus one theme, now people are talking about Euro plus one theme. And if you see some of the commentaries which are coming from global players, they are very clear that they want to diversify their supply chain. Or their manufacturing hub. And India is being looked at very closely as a favored destination. So the ecosystem, even from the global environment perspective, is improving massively. So if you talk about the demand, the supply, and the ecosystem at this point of time is in place for India to grow at a decadal kind of for the next 10 years. So we are quite positive on India as a structural story.
So I think, thanks again. Clearly, I think you put it in three very separate buckets. Personally, I think, agree with your views on the ecosystem part. And this is something which I keep discussing with my clients. Obviously, the ecosystem which I think, which has kind of gotten created, and you reaffirm those points, whether it's in terms of policies driving economic reforms. You talked about, the PLI, production linked incentive scheme. I think clearly it's creating ensuring that India becomes resilient, especially as far as domestic manufacturing is concerned. And I think the way we've also been looking at, and which you kind of reaffirmed, is that partly a large portion of this, the whole Atmanirbhar Bharat, and is to kind of look at the export side, 5 years down the line, because if we have a large part of manufacturing happening within India, it makes us more resilient. I think less vulnerable to external shocks, especially in these turbulent times. And I think it's in the right direction broadly. So thanks for your views on that, which brings us to the next question, and on inflation management. Okay, so my question is, how does ICICI Prudential AMC see inflation management by RBI, and any view on the future trajectory of interest rates? And if I may to kind of extend, do you see this impacting growth? And within the Prudential debt fund universe, what category of debt funds would you be positive on?
Sure. I think clearly, if we have to put it out in just one line, how RBI has managed the inflation dynamics, I think they've done a great job in terms of that. Because if you look at, we have not expanded our balance sheet so much during the pandemic period as India, as compared to if you look at US or any other global central banks, they have expanded their balance sheet massively.
Correct.
Right, and that's why they are seeing so much of liquidity in the system, and due to which the inflation is like unheard, I can say that. Yani, it's US almost close to 9.1, and when India is sitting at around about 7.5, it's like shocking for people that US inflation is much higher than an emerging market like India and all that.
Right,
so I think that's very clearly a point which we need to take from how RBI has handled the whole equation of ensuring that we are not going overboard. We are not running at that fifth gear thing that we'll go all out. That has not been done in the last one and a half. They've done a very systematic approach, ensuring that growth remains buoyant. There is small elements which have been given or catalyst which has been provided for growth to pick up. In the meantime, also ensuring that the inflation is also kept in a tight lid kind of thing, right? So they've managed both equation very nicely, growth and inflation dynamics, and that's why you're seeing India's inflation is also not running out of control. It's still there, although it's slightly on a higher side, but it's something which is not a worrisome like what we are seeing in US, Europe market and all that. So what we believe going forward also, what we are expecting is that there would be small, you are going to see incremental rate hikes from RBI side also, and then that's mainly to do with to control the inflation in a much better manner. But we don't have to be outsized kind of a rate hike is not required, right? What is done by US. So there would be rate hikes which would be there in the upcoming policy from RBI side, and we expect this is what the market consensus is also, that your repo which is currently at 540 may close at a terminal rate of close to 610 or 615, which translate to close to a 75 basis point rate hike in the coming 3-4 meetings. So that's how we expect RBI would be behaving, and they have done a great job in terms of managing the growth and inflation dynamics. Your second question on in terms of in such an environment, the category of scheme which we like at this point of time. And one thing which we have been very vocal in terms of recommending on the fixed income side is our any scheme which has a very good exposure to floating rate bonds, right? So when we talk about floating rate bond, it's like you are taking a house loan, right? So a floating house loan, and when you go for a floating house loan, it's like today you are paying 6% on your loan, and after 1 year, if the loan rate, because it's a floating loan rate, so if after 1 year if the rates goes up, you have to pay a 7%, and if next year it goes up, you have to pay 8%. Simple equation, right? If you reverse that, and you are buying a floating rate bond, it's like a benefit for the holder who is having that bond. So like this year you are giving a 6%, you are getting a 6% accrual or coupon on that floating rate bond. Next year, if RBI hikes the rate, and if let's say the rates move by 1%, your floating rate bond coupon would be 7%, and if RBI further increases it, you're going to get a higher coupon. So it's a simple equation where the investors benefit of investing in floating rate bond in a rising interest rate environment. So clearly we are all out. We are very positive on floating rate bond as a category. So which all schemes invest in that floating rate bond would be a great addition, and it has actually done well. The second category of fund which I'll just highlight is schemes which can dynamically manage their duration. So you have heard me talking that you need to have flexibility, you need to have smart asset allocation on the equity side. I think the same comes over here.
On the debt side as well.
Exactly, on the fixed income, because the macros are moving, macros are challenging. So on the fixed income also, you need to have active duration funds, dynamic duration funds, which can manage their duration when interest rates are high. You can take the duration higher when the expectation of interest rates coming down. You can stick to the longer duration, but if you are feeling that it's going to be extremely volatile, then you can manage the duration very smartly. So active duration is something which we recommend.
Great. Thank you for sharing your inputs on that. And I think very clear view from Manish on this, and I must say that India probably is one of Indian Central Bank, the RBI, is one of the banks which is actually doing a fine balancing act, if I can say. And if I were to assume that probably India is the only country, probably, where the central bank manages the government expectations of growth, while at the same time, come on managing the inflation, which is really the mandate as per the MPC.
Correct.
So I guess it's not. It's I think it's a delicate situation, but RBI, as I hear from you, has been
They have done
they have done a decent job.
Correct.
On the contrary, if you look at developed economies, whether you look at the ECB or the Fed, I think they clearly come with a target role of managing inflation.
Okay.
And somewhere, if I may to quickly add to what you said, I think the Fed is very clear that it's going to increase rates, irrespective of its
Yes.
impact on growth. So a very engaging perspective from both sides. How a developed economy is looking at growth versus inflation, and how a developed economy like the Fed, which is completely in an inflation targeting role, and it really doesn't seem to bother about growth. So good perspective. Thanks for sharing your inputs. Which brings me to our next question. I keep having discussion with clients and in all our meetings with the various stakeholders, including institutional clients, domestic clients. I think the first question which we keep on coming out is that there's always a thing about capex. So if I look at this year's budget, the government clearly earmarked as 7.5 lakh crore capex. So my question to you is that how do you see the government and the private sector capex shaping up in the coming months ahead, and probably if you can share what are the latest numbers financially till date, and how do you see this? How do you see the capex on both sides, government and private sector capex over the next 2 quarters and for FY24? Some direction on that helps.
Sure. I think this is a question which can be a brief introduction or brief explanation which I have given in the previous questions which you have asked.
Okay.
And the role of government is to push the private players or private companies when the investment environment is not happening in a big way.
Yeah.
So there are times when you will see government taking the front seat in terms of the overall capex, and there would be times when you will see government taking slightly a back seat and giving the baton to the private players.
Yeah.
So over the last 2-3 years, we have very clearly seen that government doing the bulk of the capex, and that's through mainly, I can say, infrastructure related capex which they have done.
Yeah.
And if you look at infrastructure capex, it's growing at a 10% annually.
Yeah.
Barring the COVID year where they have kind of reduced the overall budget, but apart from that, if you look at, it's been growing decently at 10% kind of a thing. And if you look at all the projects which they have clearly put across, whether it's the logistics policies which they are coming up, whether they are talking about Bharatmala or Sagarmala, clearly it is something which is a very high focus towards infrastructure spending. And the benefit of having an infrastructure expenditure is that it has a very big multiplier effect. When you talk about spending, a government can do spending in 2 ways. Either they can do infrastructure related spending, or they can directly give the spending, or they can directly pass the benefit to the final user or consumers through, like, let's say Manrega or through food subsidy kind of a thing. Now the difference between these two expenditure is that when you do a Manrega or a food subsidy kind of an expenditure, the multiplier effect is much lesser. So when it comes to a consumer like me, I may use that for an FMCG or buying some anything which is related to FMCG or a pharma, medical bills, etc. and all. So it ends over there. When you talk about infrastructure kind of a spending which the government has been doing for the last 2-3 years, there it's so if I take an example, like let's say if you have to build a road, So you have look at the kind of sectors which come into picture. So when you have to build a road, you need cement, you need roads, you need transportation vehicles, you need almost a hefty amount of manpower who should be working on creating those roads. So you have a touch points which is touching many sectors at a time when you're doing a infrastructure related activity. So that's why we believe when the expenditure is towards infrastructure, it's called a high quality spending. It
Right.
has a much better multiplier effect. The whole economy comes into picture. So that's what the government has been doing for the last 3-4 years. So infrastructure spending has been very positive, especially from the government side. So various projects which has been initiated by government, that something is giving. Now, the second element which I have highlighted, that at some point of time, even government should push the private players or
To
private
kind of-
companies to do capex. That is also creating beautifully. So PLI incentives is something which is, in short, government is pushing private players
to kind of
do this kind of a production, and I'm going to incentivize you for doing this kind of a thing. So they are very clear that when the 14 sectors has been put across, these sectors are very clear that we are going to go for a big production, we're going to look for export, etc. and all. So definitely there would be a much spending from the private players is also which is going to come up.
Okay.
And government is also keen on indigenizing lot of defense kind of an warfare equipments, etc., which comes in. So we had a 60% kind of dependency on from other countries to get our defense needs met. But now they're very clear that they wanted to do more of indigenization of that. The initiatives on the auto ancillary segments is moving massively. I can give you some examples. I can go on and on the way private players are going. I can give one example of like when I was discussing with you earlier that for producing an AC, right? When you have to produce in India, there's a part which comes from abroad, and that cost for that part is 40% of the overall AC. So the 60% used to get produced in India, but that 40% need to come from outside. But last few months, even we have been able to crack that 40% element also in India. So 100% complete indigenization AC can come. So there are huge examples I can say like this is getting played out over here. So the private capex is also moving in that direction with government's push towards PLI and all. And plus, like I highlighted, the last element that is on the demand side is customers looking positive on the products and services offered by these companies. If private companies clearly sees there is a demand from households and all, then they can build up capex. So with credit growth picking up 15-16%, capacity utilization picking up to 75-76%, there is a clear visibility that government is supporting us. Now the demand is also coming nicely, so we can go for more projects and all. So both the environment is looking at this point of time very positive, and this can really play out well for India in the coming years.
And this is an interesting perspective, and it takes me back to the previous question. So, if I were to look at the elements of GDP for any country, and you have, government spending, consumption, private sector investments, and then net merchandise exports. So, historically, if you see that, obviously, India as an economy has been predominantly consumption driven.
Correct.
I did cover an article on consumption. I shared my views some time back. But I think clearly as we go to the next part of this decade, clearly the element which has been the missing link was net exports. I think that's something, as compared to China, we've been very weak. But if I were to infer, and the PLI keeps coming back in different forms, I would like to bring the latest example of, the Indian defense you were talking about, the indigenous aircraft carrier which was there. I think that's a feat which has come up a long time. I think it cost some, a couple of thousand crores. It was several decades in the making, but phenomenal feat. And I think coming to the budget as well, as we said, 68% of the procurement has to be done domestically, which was outlined in the budget as well. So I think we are seeing the threads moving in that direction,
Absolutely.
and I think you reaffirmed some of those points. But I think the exports should be the next drive over the next 5 years plus, and this PLI should lead in
Yes.
that direction, hopefully.
Yes, surely. Like India's export share is still on a lower side.
Yeah,
You can say roughly around 1.8, 1.9% in terms of, if you look at the global share of exports
yeah.
from India, it's close to 1.9, but it's picking up very well. It's picking nicely.
Good.
Major players have started realizing that you need to diversify your supply chain, right?
Absolutely.
You cannot be stuck in one or two countries. So that's happening, and India is becoming.
Okay. For the sake of time, I think one last question. I think what are the sectors or themes you are positive on, and what would be the rationale behind those?
I think most of the rationals are the whole talk which we have done. I think you can clearly make it out the sectors or themes which is expected to do well in the coming years. I think one theme, and we started a discussion on that. We are more positive on domestically faced economies which are more focused towards India's economy picking up. So if I talk about banking, is a very strong play on Indian economy doing well, and the way banking sector has picked up or shaped up, I can say that balance sheet is looking much decent again. If I talk about banks, the non-performing assets have kind of come down, and they have done from 2018 and all, where we have seen NBFC crisis, etc. Post that, the bank's balance sheet has improved a lot. Their net interest margin has started to improve nicely. Their return on assets, which we look at a very important aspect for banks, that's starting to move nicely. Credit growth, which we've been highlighting, that it has touched 15-16%. And in a rising credit growth kind of environment, banks is a beneficiary, because
Absolutely.
everybody want to borrow, right?
So clearly banks and financials is one sector.
Banks and financials is one sector which we like. We like auto, we like especially like transportation and logistics as a space. And that's because, again, like I said, penetration is low, the user set is huge, there's clearly a demand from global side. They want to set up manufacturing hub in India. So auto ancillaries, logistics space is something which we are positive on. Manufacturing, cap goods, discretionary, all this is something which is domestically faced, is something which we like.
And I would like to add to the point, the NLP, the National Logistics Policy,
yes,
which the PM unveiled some time back.
Correct.
I think this is clearly pointing out to the logistics space. And I must share with the viewers here that the logistics cost for India as an economy historically has been around, if I look at the global average, I would say it's around 8%. And if I look at India, the logistics costs have been pretty much around 12% plus levels.
11 to 12%, absolutely.
So I think the endeavor here is to kind of bring this at par with the global average. It's like
or 5% below
of GDP, in line with the global average. And my personal view is that if we are able to do that in the next couple of years, like you said, a seamless logistics would have a positive trickle-down effect on so many sectors.
Absolutely.
Because, if I'm a manufacturer, obviously I want to sell my goods across states. We are already seeing, rationalization with e-way bills. And if I can have, a kind of a comfort factor that I can transport my goods, one, seamlessly across the country, and
absolutely,
even beyond, I think it makes life much easier.
Absolutely. And plus, if you look at e-commerce industry, that's a flourishing industry, and backbone for e-commerce industries, you need three things. You need a good payment system, and India has a solid payment system, so there's no doubt about whether you're talking about UPI, Google, internet banking. Second thing which you should have for a e-commerce industry to flourish is a data consumption, or mobile data, internet connectivity. India has one of the cheapest data consumption country, you can call that, with thanks to the telecom players in India. Third thing which you like to have for a e-commerce to flourish is logistics. And everybody is very clear. So all the major giants in the e-commerce space, they are very clear that India, we need to set a very solid logistics setup. And that is giving rise to many private players in the logistics space to expand, more spending efficiently, and government is also supporting that with the dedicated freight corridor which you've like mentioned, or NLP project which they are coming up with, logistics costs coming up. So I think logistics is a space also which can play beautifully. I'm just giving one more number for logistics because that's something which we like, and coupled with transportation logistics, logistics market, if you look at the overall market, it's just 3.5% to 4% is what the share of organized players is there.
Okay, that's an interesting
number. The rest,
number.
96-97% is unorganized players.
That's
a huge number, exactly.
Interesting.
And logistics contribute almost 14% of the GDP. So it's a big market. But it's contributed only 3.5-4% by the organized players. So clearly, with e-commerce coming in, you will see a lot of logistics players moving from, let's say, unorganized to organized shift. You're going to see a lot of players getting listed. So I think that whole space of transportation plus logistics, because logistics, you need transportation, all that is going to
and I think it should lower the cost of logistics also in the longer run.
Yes,
like which I pointed out in the initial.
Correct.
Great. I think very informative. I must take this opportunity to thank ICICI Prudential Asset Management Company, and thanks Manish for sparing your time out of a busy schedule to share your views and perspectives. So on behalf of AKC Capital, my word of thanks to you, and to our viewers as well. Thanks for your time, and on behalf of AKC Capital, we'll be back soon with another informative session on the markets. Keep watching out this space. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.